everybody. Adam Parks here with Trinity Wealth Management. I'm here today with Eugene Choi from Dunham Trust Company. And Eugene and I are talking about taxes. And that's one thing that we love talking about over here. And we don't like paying them, but we do like to talk about them because it's very, very important. Two things you can control in your investments are the risks that you're willing to take and the taxes. And knowing that taxes are going to be a big, big change next year, how do we protect our clients and prepare you and your portfolios to take advantage of the benefits that you are allowed and also protect you from some of those changes. So what we're talking about today is a charitable remainder trust. And one of the benefits and the strategies that we use with the charitable remainder trust is it gives you certain tax breaks to be charitable. So not only do you get to do a good thing while you're alive, but then you're also able to reap some tax benefits. So for example, if you were to love your church or love a St. Baldrick's or St. Jude's or something like that, and you really, really want to make an impact for them, you might one day consider making a large donation at the time of death, your death, to that institution. And of course, there's a tax breaks for doing so. However, you're passed away already, so you're not going to really see the look on the impact that you're making, correct? So why not do it early? So that's another thing that we're talking about here with Eugene. So Eugene, I didn't want to leave you out there for a minute though, but thank you for joining us. I appreciate that.
Of course. Thanks for having me, Adam.
Yeah. So Eugene, talking about the Charitable Remainder Trust, you and I have had a few conversations about this recently about how you at Dunham Trust Company are using it and how we're using it here at Trinity. And it's really nice to kind of put the two together because both strategies are very beneficial. The way that it works from our side is unique because we're looking to protect and give the benefit to the clients while they're still alive. And one of the strategies that you're talking about is how to protect the beneficiaries after the client has passed away. So what I'll do is kind of pass it to you if that's okay, and tell me about how you are using, how Dunham Trust Company would put a charitable remainder trust in place in order to benefit one of our clients.
Sure. Well, everyone has an IRA, right? Everyone has a 401k as well. Adam, you have one, I have one. One of the first things that we do is we set up a beneficiary of our IRA 401k. It's what we learned when we first set up the account. And 99% of the time, the beneficiary is your spouse, right? Contingent beneficiaries. So if you and your spouse were to pass away at the same time, contingent beneficiaries are usually children. What the Charitable Remainder Trust does, and the way we're using it at Dunham Trust Company, is to provide a way for clients to get around the Secure Act. And so as you know, and for those watching this, some may or may not know, the Secure Act was passed in January of 2020. It went into effect. A lot of the provisions that came from the Secure Act eliminated a lot of benefits and also gave some benefits. But one of the benefits that was eliminated was the stretch IRA. So before January of 2020, if I had $1 million IRA, and let's say I was a widow, and let's say my beneficiary was my son, if I passed away and my $1 million went over to my son, before the Secure Act went into place, my son was able to take out and stretch out that income over their life expectancy. But now, because of the Secure Act, my son is required to take out my $1 million over the course of 10 years.
And right. So it's a lot easier back then. We can manage those taxes doing the beneficiary stretch for sure.
Absolutely. And so on $1 million IRA, what if my son doesn't need the money? Let's say he's well off, he has a good job, married, he's not in need of the money. On that 10th year, if he takes out $1 million, that's a really, really big tax hit, right? And it's just
and if he's half as successful as you, he's going to have a high income, and then you throw that on top of that income for 10 years, and you're losing a chunk of it to the IRS.
Exactly. And so going back to the Charitable Remainder Trust, the way we've been using it at Dunham Trust Company is to set up the Charitable Remainder Trust as the beneficiary of my IRA. So instead of having my son be the beneficiary of my IRA, I'm going to create a Charitable Remainder Trust and have that be the beneficiary of my IRA. Now, when you do that, there's a couple things that happen. And the three things that are really important to note about these charitable remainder trusts in setting up that as the beneficiary of your IRA or 401k, the first major thing is that I don't lose control over that IRA. All I'm simply doing is changing the beneficiary to the CRT. So if I decide, 10 years later, I don't really care about this. My son's turned his life around, or he actually is in need of the money. Then all I do is just change the beneficiary back. I can deplete the money in my IRA assets down to zero if I wanted to. I can take out distributions like I normally would. All you're doing is you're changing the beneficiary to the charitable remainder trust. Now, here's the really key thing about why this strategy bypasses the Secure Act. The charitable remainder trust is a tax exempt entity. That means that you eliminate the Secure Act tax of needing to take that out over 10 years when I pass away. So if I have my $1 million IRA, I set up the charitable remainder trust as my beneficiary. And that 10th year, I do not get hit with that huge tax bill because the charitable remainder trust is that tax exempt entity. So that means more money and more assets in the trust, which means more lifetime income for my son. Because again, a charitable remainder trust, since it bypasses the Secure Act, it gives my son a lifetime income over his life expectancy.
And then once he passes, then it goes on to the charity.
Correct. So that is something to balance out, is that if, let's say my son's 30 years old when I pass away and I leave $1 million to him, let's say he passes away 5 years later, that's an unfortunate, that's a risk that you take, because then the remaining balance in there, 950,000 or whatever their balance is, that goes to charity. So what you want to balance this out with is take a look at your family history. If you believe that your son is going to live, or if you have a really healthy family tree, you live into your 80s, 90s, it could be a solution to provide that lifetime income for your children. The last, go ahead.
And for compliance purposes, that's section 664 in the IRS code. So
yeah, the last good job with the compliance thing. The last benefit, or there's multiple benefits, but the last key benefit is that my estate will also get a tax deduction, because again, the charitable remainder trust won't take into effect until I pass away. But when I pass away and then the assets go into the charitable remainder trust, my estate is going to get a tax deduction. And the reason why that's important is because right now the estate tax exemption is around $11 million per person. The Biden administration is looking to claw that back and bring it back down and lower it to $3.5, $4-ish million. And so for those individuals that have an estate of 8-9 million that have these IRA assets, if it's not done through a CRT and it's just left with me passing away and going on to my children, having it done in a CRT gives you the advantage of being able to take a tax deduction for your estate.
Absolutely. When you were talking about that, I was thinking that as far as the estate tax being the limit being lowered, you could be $1 million client right now, not even a $9 million. We're actually having these conversations with some clients now, saying that you're not going to be affected by the estate tax today, but if that changes to 3.6 and you have $1 million IRA and it grows for 2 years, or grows for 20 years, you could absolutely be in that situation or higher. So big things, big changes with the Secure Act, and from a tax planning standpoint, Eugene is talking about doing something to help the beneficiaries and to do that stretch IRA. While what we're trying to do also on the while you're living to benefit you side, imagine you have $1 million IRA and you take $500,000 and you put that into a Roth IRA. Well, that's going to generate a large tax bill. But then you could take the other half of that IRA and throw that into or name it to the Charitable Remainder Trust and gate that tax deduction, which then could negate, talk to your tax professional, could negate that tax liability. So in essence, you're taking $500,000 or half of your money, moving it into a tax-free growth bucket. And then the other half of your money is then generating income for as long as you're alive. And then that goes off to the charity at the time of death. So it's a really, if you're going to lose that much in what would you rather pay, the tax man or your family? So one way or the other, we're going to have to pay the taxes. It's just a matter of how we're doing it and being smart about it. So Thank you, Eugene, for being on the call with us. I mean, this is one of just many strategies that Dunham and Associates and Dunham Trust Company are helping us with. And Eugene is a wealth of knowledge, so I like to bring him on the call and bring him on and show that shiny face, even though it's 7 a.m. in California. Eugene, thank you very much for being here. I appreciate it, and we'll be in touch. And our information will be down below. So if you have a large IRA or any questions like this, feel free to give me a call. Give us a call here at Trinity Wealth Management. We'd happy to walk you through it. Thanks very much for being here again, Eugene. We'll talk to you soon.
Thanks, Adam. Take care.